Picture this. You've worked your entire bloody life. 40-odd years of alarm clocks, tax returns, mortgage repayments, and Sunday afternoon mowing that lawn you never actually liked. You did everything right. You paid your taxes, raised your kids, looked after your parents, and finally, you're sitting in a comfortable retirement with a secure, fortnightly age pension landing in your bank account like clockwork. Your family home, the one you bought back when the neighborhood was still considered affordable, has gone absolutely ballistic in value. The market did what the market does. And now at this beautiful, well-earned chapter of your life, the plan seems dead simple. Sell the big house, buy a smaller villa closer to the grandkids, and park a bit of extra cash in the bank to enjoy your golden years. It sounds logical. It sounds sensible. For most Australians, it sounds like exactly the kind of responsible financial decision the government would want you to make. It isn't. For thousands of completely unsuspecting Australian seniors every single year, that exact scenario is turning into a full-blown financial horror story. And the trigger is a hidden compliance minefield that almost nobody talks about until it's already too late. It's called the $321,500 trap. And if you think you know how it works, I'd bet good money you don't. Not the forensic machine-level reality of how Centrelink's automated algorithms actually process your case the moment you sign that contract of sale. Today, we are going to change that. I'm going to give you the exact tactical roadmap built around the mid-2026 compliance environment to protect your pension before you ever list your property on the market. But first, you need to understand just how deep this rabbit hole actually goes. Let's start at the foundation because you need to truly grasp why this trap is so brutally effective. Under normal circumstances, your family home holds an almost magical status inside the Services Australia compliance framework. Your principal place of residence is 100% exempt from the Centrelink assets test. It doesn't matter if your home is worth $500,000, $2 million, or $5 million. As long as you live in it, its value is entirely invisible to the compliance algorithms churning away inside the Centrelink mainframes. A $4 million harbourfront terrace and a $400,000 fibro cottage are treated identically. Both register as zero. That is an enormous financial advantage. It means a retiree sitting on a highly valuable property can still receive the full age pension because that asset simply doesn't exist in the eyes of the system. It's the government's long-standing acknowledgement that Australians shouldn't be forced out of their homes just to fund their retirement. But here is where things get genuinely dangerous. The absolute second that property settles and the sale proceeds hit your bank account, that ironclad shield evaporates completely. You transition instantly, automatically, with no grace period and no human review, from being assessed as a homeowner with a fully exempt property to being scrutinized under a rigid set of asset and income tests where every single dollar is weighed by a machine that does not care about your circumstances, your intentions, or your timeline. And that machine is looking for one number above all others. Up until the 1st of July 2026, the exact maximum asset-free threshold allowing a single homeowner to receive the full age pension stood at $321,500. Even as the brand new July 2026 indexation adjustments push that full pension threshold up slightly to $333,000, the fundamental mechanics of the trap are unchanged. The threshold moves, the trap doesn't. Here's the brutal bit. If your assessable personal assets, bank accounts, vehicles, superannuation, share portfolios, home contents, exceed this baseline by even a single dollar, your pension is immediately reduced by a taper rate of $3 per fortnight for every $1,000 you are over the limit. And if your total assets blow past the absolute part pension disqualification threshold, moving to $733,500 for single homeowners this July, Centrelink doesn't gradually reduce your payment. It cancels it entirely, overnight. No phone call, no letter first. The algorithm flags the account, and the payments stop. Now let's look at exactly how ordinary, well-intentioned Australians walk straight into this trap, because there are 3 distinct triggers, and each one catches a completely different type of retiree. Meet Robert. He's a 71-year-old retired electrician from Melbourne's eastern suburbs. He's lived in his family home for 34 years, raised 3 kids in it, and it's now worth $900,000. He wants to downsize into a beautiful retirement villa closer to his youngest daughter. Asking price $550,000. Robert is not financially naive. He knows there's something called a 24-month asset exemption for home sale proceeds, and he knows that the $550,000 he plans to spend on his new home is protected from the assets test while he waits to settle. He's done his homework, or so he thinks. Here's what Robert doesn't see coming. After paying out his costs and putting $550,000 toward the new unit, Robert has $350,000 in leftover cash sitting in his bank account. Under the Centrelink rules, that $350,000 is classified as excess proceeds, and it is treated as a fully accessible financial asset from the day of settlement. There is no exemption for it. There is no grace period. The moment it lands, it's counted. When that $350,000 stacks on top of Robert's existing personal assets, his super balance, his savings, his car, his total assessable position rockets straight past the $733,500 disqualification threshold. The automated compliance sweep picks it up at the next fortnightly cycle, and just like that, Robert's pension is cancelled. Not reduced, cancelled. The fortnightly income stream he budgeted his entire retirement around, gone. No transitional arrangement, no automatic review, just silence where the payment used to be. Robert didn't do anything wrong. He didn't try to game the system. He downsized responsibly, like millions of Australians are encouraged to do. But he didn't understand the one critical distinction. The exemption applies to the funds intended for reinvestment, not to everything you receive from the sale. The leftover cash is live ammunition in the assets test from day one. Now here's the trap that's even more insidious, because it catches the retirees who are doing everything right, the ones who aren't keeping a cent of leftover cash, the ones who genuinely plan to spend every single dollar of their sale proceeds on a new home. Let's say Margaret sells her home in Brisbane for $800,000 and intends to use the full amount to build a brand new house from the ground up. She notifies Centrelink promptly. They correctly apply the asset test exemption to the full $800,000 for up to 24 months while construction proceeds. Margaret breathes a genuine sigh of relief. She believes her pension is completely safe. It is not. And what follows is one of the cruelest mechanics in the entire Australian social security system. Here is the part that almost no financial advisor bothers to explain up front. While those proceeds are fully exempt under the assets test, they are absolutely, categorically not exempt under the income test. These are two completely separate compliance frameworks. Passing one does not protect you from the other. While that $800,000 sits in Margaret's bank account or a term deposit, waiting for builders' progress payments, council approvals, and construction milestones, Centrelink applies its strict deeming rules to that entire cash pool. The system looks at the balance and calculates a fictional deemed income, phantom earnings the government assumes you are generating from that money, whether you actually are or not. And here's where the mid-2026 environment makes this dramatically worse. On the 20th of March, 2026, the federal government officially ended the multi-year freeze on deeming rates. The lower deeming rate moved to 1.25%, and the upper rate climbed to a genuinely punishing 3.25%. Even using the lower rate applied to a portion of the proceeds, having $800,000 sitting in an account generates an enormous amount of paper income. Income that exists only in the algorithm's calculations, not in Margaret's actual bank balance. When the automated system runs its fortnightly income matching sweep, that artificial deemed income frequently blasts straight through the income-free areas, capped at $226 per fortnight for singles, and $396 for couples under the new July 2026 guidelines. The machine looks at the number, determines Margaret is earning too much, and slashes or suspends her pension. All without a single human being reviewing the decision. Margaret did nothing wrong. She followed the rules, she reported correctly, she's building her new home. But the income test doesn't care about any of that. It sees cash, it calculates phantom income, and it cuts her off. The assets test exemption that she was told would protect her doesn't touch the income test at all. The third trigger is operational, and it destroys people through sheer administrative complexity rather than asset or income levels. By Australian law, the absolute moment you exchange unconditional contracts on your home or reach settlement, you are legally required to notify Services Australia within exactly 14 days. Not 15, not 21, 14. And the notification process requires you to submit highly specific real estate forms, clearly and precisely declaring your intention to purchase or build a new principal residence. If you miss that window, even by a day, the system can revoke your temporary homeowner classification. If you submit the paperwork, but then change your plans and decide to rent indefinitely instead of buying, the algorithm classifies your entire sale amount as a standard liquid financial asset, and your full pension exposure is immediate. But the cruelest version of this trap catches retirees who genuinely intend to build or buy, who report correctly, who submit every form on time, and then run into the unpredictable chaos of the Australian construction industry. Builder liquidations, council approval delays of 6 to 12 months, supply chain blowouts, flood-related planning restrictions. These are not rare edge cases in 2026. They are common documented realities across Queensland, Victoria, and Western Australia particularly. If your new home build runs past the 24-month exemption window due to circumstances entirely beyond your control, you must proactively provide ironclad documentary evidence, ongoing correspondence, builder contracts, council communications, site inspection reports, proving you are making reasonable, continuous attempts to complete the purchase or construction. If the system detects even a single lapse in your documented intent, a gap in correspondence, a delayed evidence submission, a council approval delay you didn't document thoroughly, it drops the hammer. The funds are reclassified. The pension disappears. And you are left trying to fight a bureaucratic machine that has no memory of your good faith. So how do you neutralize all three triggers and make sure your downsizing journey doesn't become a financial disaster? Here is the exact roadmap. Step 1 is to partition your funds the moment settlement occurs. Set up a dedicated, clean bank account, completely separate from your everyday savings, personal cash, or any other financial asset, exclusively for the portion of the proceeds intended for reinvestment in your new home. Do not commingle these funds with anything else, not even temporarily. This single administrative action creates a pristine paper trail that gives Centrelink compliance officers exactly what they need to verify your intentions. An account that has never had a coffee purchase or a Netflix subscription on it is worth its weight in gold when you're dealing with a compliance audit. Step 2 is to file the Centrelink Mod R real estate form within your mandatory 14-day notification window from the date of contract exchange or settlement. It must explicitly, clearly, and unambiguously declare your legal intention to reinvest those specified funds into a new principal place of residence. Do not rely on a phone call. Do not assume a verbal conversation with a Centrelink representative is legally sufficient. Submit the form in writing, keep a dated copy of the submission, and where possible use a delivery method that generates a receipt or confirmation number. Step 3 is to run a proactive income test projection before you sign anything. Before you finalize your timeline, before you sign the contract of sale, before you agree to a settlement date, before you lock in your build contract, you need to understand exactly how much phantom income your temporary cash pool will generate under the March 2026 updated Deeming rates. Work with a specialist retirement financial planner, not a general practitioner, not your accountant, but someone who operates specifically in the Centrelink and aged care compliance space, to run this projection and identify whether you need to restructure your accounts, adjust your timeline, or explore specific asset management strategies to keep your deemed income safely under the income-free threshold. Step 4 is to build a living document file for your construction evidence trail from day 1 of the build. Every email with your builder, every council lodgement acknowledgement, every site inspection report, every progress payment receipt, every piece of correspondence that demonstrates active, continuous pursuit of your new residence. If delays occur, and in the current Australian construction environment, delays are almost certain, you want to be able to hand a Centrelink officer a thick, time-stamped chronological evidence file that makes it categorically clear you have been acting in good faith at every single stage. Here is the thing that needs to be said plainly, without hedging. The Centrelink compliance system was not designed with your circumstances in mind. It was designed to process volume. Millions of claims, millions of updates, millions of account sweeps, handled by algorithms that do not read context, do not exercise judgment, and do not distinguish between a retiree who is genuinely transitioning between homes and someone attempting to exploit an exemption. That means the entire burden of navigating this system correctly falls on you. And that is deeply unfair for people who spent decades paying into a system they trusted to support them when they needed it most. But unfair or not, the reality of mid-2026 is clear. The deeming rates are rising. The threshold indexation is happening. The automated sweeps are relentless. And the only protection available to ordinary Australian retirees is precise, proactive, documented compliance, executed before you ever sign a contract of sale, not scrambled together afterwards in a panic. Your family home is almost certainly the largest single financial asset you will ever own. The decision to sell it, downsize, and reshape your retirement lifestyle is one of the most significant financial moves you will ever make. It deserves the same level of strategic preparation and professional advice that you would give to any major financial transaction. Because in the current Centrelink environment, the cost of getting it wrong isn't just inconvenient, it's your pension. Overnight. Gone. Track the July 2026 threshold updates. Understand your reporting timelines down to the specific day. Get specialist retirement planning advice before you list. Partition your funds from day one. Build your evidence file from the first brick. And most importantly, don't assume the system will give you the benefit of the doubt, because it won't. The algorithm doesn't do doubt, it does numbers. Your job is to make sure your numbers tell the story you need them to tell, clearly, cleanly, and long before the machine ever looks at your account.